Everyone, we are off to the races. Anderson opening the equity markets here at the New York Stock Exchange as it prepares to see its shares debut for trade. We're going to hear from the CEO in just a few moments once he gets down to the trading floor after ringing the bell. We do see the equity markets opening fractionally higher. In fact, the Dow up 0.4%, the S&P 500 up by about 0.1%. I do want to bring in a guest to talk more about these markets, Tom Bruce. He's macro investment strategist at Tanglewood Wealth Management. Tom, great to have you on the show this morning, especially joining us down there in Houston, Texas. What do you make of the market at these levels, including what seems to be a broadening out into more of these cyclical sectors as we see by the Dow's advance today?
Morning. Thank you for having me. So, as a whole, we're pretty optimistic about the market going into next year, but there's a few factors at hand that could kind of constrain things going forward. We've had a series of good years, and it doesn't mean we can't continue having another good year. But if you look at where valuations are at now, there's a number of studies showing a low long-term expected return, maybe even negative one. So it doesn't mean that 2026 is going to be a bad year, but over the long run, some kind of lower return going forward wouldn't be a big surprise. That said, there are a number of tailwinds going into 2026. We still have one big beautiful bill that should broadly contribute to growth, and the rollout of AI, the investment into AI, should continue to really help the economy, broadly speaking, going into next year.
So I do want to ask about what this means for someone's portfolio, Tom. How are you advising clients, or what are the conversations that you're having with them with this expectation as to how they should be structuring their investments into 2026?
Good question. Well, from our perspective, it looks to us like there may be more of a rotation going into more the value type names instead of the high growth names that you've seen to perform so well in recent years. Aside from that, though, as you have more of this rotation going on, there may be elevated volatility. Another factor that we're weighing seriously is a potential rise in interest rates going into this year. I'm not talking about the federal funds rate. We may have another cut there, maybe two cuts. So we'll probably finish the year maybe slightly lower or flat to where we're at now. But on the long end of the curve, there could be some pressure going forward, and that will originate from a lot of global debt issuance. Countries around the world are issuing debt, not just the U.S. And you're seeing yields rise in countries like Japan that are spilling over into the rest of the world. So you're getting higher rates because of that, coupled with all this AI investment and the capital needed to go into that. In previous years, it was financed through company operations from hyperscalers, but as they have to turn the debt markets, starting in 2025, but going into 2026, all that aligns for a lot of pressure for the long end of the curve, perhaps going forward.
We've been talking a lot about artificial intelligence, and we saw the AI space companies, especially in the semiconductor industry, exposure to data centers, things of that nature, because we know so much power is needed to generate this AI play, rebound and lead, in fact, with double-digit gains since that April low earlier this year. We're back to near record highs on the major indices, but we are starting to see a rotation, as you've referenced, into some more of these cyclical stocks. I'm just curious, as we look at the AI trade and companies across the board leaning into AI, what does that mean for the economy, especially as the jobs market has shown signs of cooling this year?
Well, as a whole, I still think it's very beneficial for the economy. The jobs market itself is kind of a mixed story because the productivity gains that we're likely to get in the future, maybe not this year, but looking out for the remainder of the decade, we'll probably start to see productivity pick up. That could weigh on jobs. That's true, but as a whole, all the investments going into new data centers, it's already affecting the real economy in a meaningful way. And I do think as you get productivity picking up as it's rolled out more, as it's integrated better into company operations, then you should begin to see a greater impact on the overall economy.
Tom Bruce, macro investment strategist at Tanglewood Wealth Management. Tom, thanks so much for joining.
Thanks for having me.